Welcome back. You're watching India Tonight. And now let's talk about the latest development that we are tracking, given the fact that NCLT, in fact, has given its approval for the merger of Piramal Enterprises with Piramal Finance. My colleague Ankur Mishra is here with the details. Take a look.
Yes, Piramal Finance has now confirmed that NCLT has given a go-ahead for merger of Piramal Enterprises as well as Piramal Finance. Now, the merger marks the creation of a stronger and more integrated financial services company as per the statement which has been given by Piramal brand. And as part of the process, September 23rd was fixed as a record date for the merger. And from this date, trading in PEL securities was ceased, and those names appear in the registry on record date will get the shares of Piramal Finance in the ratio of 1:1. And as far as the distribution and assuming of responsibilities in the companies are concerned, Ajay Piramal will assume the role of chairman of Piramal Finance, and Ajay Piramal will also continue to chair the Piramal Group, which comprises of Piramal Finance, Piramal Pharma, Piramal Realty, as well as Piramal Foundation. But who will lead the merged entity? Now, Jairam Sridharan will be the MD and CEO of the merged entity, and as far as Swati Piramal is concerned, she will continue to serve as the vice chairman of the group after this merger is completed. As far as the financials are concerned, the PEL has reported Q1 numbers with a consolidated AUM reaching 77,572 crore, which was up around 22% YOY. All in all, NCLT has now given a go-ahead of the merger, and now it will be effective as communicated earlier from September 23rd.
That's a big story that's coming in from Piramal Finance. Meanwhile, let's move on to a top story tonight. And ladies and gentlemen, in his speech in Warwick, Federal Reserve Chair Jerome Powell explicitly addressed equity prices, stating that they're fairly highly valued by many measures. He also clarified that while the Fed monitors overall financial conditions, including stock prices, to ensure policies align with economic goals, this does not currently signal elevated financial stability risks, he noted. This was his first public comment on the market since the rate cut happened. Remember, this leads us to the question that we're asking tonight on the show. Is a correction on Wall Street long overdue? And viewers, before we go on to our guests, let's listen into what the Fed chair had to say at that event. Let's listen into that particular excerpt.
These days, the market is pricing in the next 6 months what's going to happen to rates. So this is something that wasn't really the case, 50 years ago. Now markets listen to us and follow, and they make an estimation of where they think rates are going. And so they'll price things in. And so, longer term rates will move because of what the market expects, market participants expect us to do. So you'll begin to see, and you're already seeing, changes in rates. Long before we make the decision, it can often be already, priced in. I think if you look at some prices, then they're elevated relative to historical levels. There were times before the pandemic when it happens periodically. Equity prices will move up and down, and we do monitor that. But we're not targeting any level of prices for particular financial assets. We don't have a view that we know what the right price of any particular financial asset is. We do look at overall financial conditions. And we ask ourselves whether our policies are affecting financial conditions in a way that is what we're trying to achieve. By many measures, for example, equity prices are fairly highly valued.
All right, Sumita, we heard those comments, but let's get that conversation going and taking that opportunity to be introducing our guests on the show tonight. Mayuresh Joshi, Head Equity Market Smith India, and Anurag Singh, Managing Partner, Ansett Capital. Mayuresh, as well as Anurag, thank you for taking the time out, and it's always a pleasure when you guys are on the show. Let's begin with the fact that, Mayuresh, given the comments that we're looking at from your vantage point, I first want to understand, how are you decoding this?
No, so I think the entire perspective in terms of how the global events are shaping up at this juncture is definitely having a say in terms of the Indian equity market specifically. more or less because of the additional tariffs that are still put in place. And there is no resolution probably in sight, at least at this juncture. Obviously, I think Trump's tweets, which probably change every passing day, give hope one day, and the other day it's again confusion created as far as equity markets are concerned on whether these macros might get resolved at some point of time. And therefore, I think that becomes a big overhang onto the markets on the global front till these additional tariffs are resolved. Because with these tariffs, and if they continue at the rate at which Trump has imposed them, it definitely shaves off the Indian GDP to a certain extent. It might get offsetted with the GST rationalization that has probably happened. But with exports probably expected to take a hit if this stays as status quo, I think that has to get diverted to other markets, which is not an easy task. And even internal consumption for such a huge aspect in terms of different areas becomes a little bit difficult at this juncture. So I think that does become an overhang for the market along with global events that are probably shaping up. What the Fed does in terms of rate cuts going forward is something to be seen, but even those comments probably seem to be a little shaky at this juncture, looking at macro data points that are shaping up.
Absolutely, Mayuresh. It'll be interesting to see Fed's policy movement going forward into the remaining months of this year. But Anurag, let me get your thoughts on this point. In terms of a trigger point, what will dictate the markets going forward? Is it going to be tariffs, given the fact that there's been a change as far as government's tariff policy is concerned? Donald Trump stating one thing one day, and then he changes his stance, and then there's something else that comes out. So there's no stability. Secondly, Fed's policy, and then price action, and then how the dollar behaves post that.
Sumita, I would see it a little differently. I think there is a great amount of stability that the US markets can see from now. One is a stability of deregulation that's happening across industries in US, right? And that is partly being reflected in the US markets. That is reflected in the Goldman Sachs and Morgan Stanley results that investment banking is at an all-time high. And that's reflected in the general business sentiment positivity across US. So that's one point. Tariffs was one element of the government policy that's largely behind us, and I think in hindsight, as the time passes, investors are realizing that this might be actually net positive for US and not net negative, right? Aside of US gaining some revenue, US has pulled the leverage on its trading partners like never before. And the third element is low taxes, and the bills have already been passed, and that's also beginning to reflect and will continue to reflect in the earnings of the corporate. So all the earnings estimate, majority about 70-80% revisions are on the upside for this quarter and the next quarter. So overall, I think I see it a little differently. I understand what Chair Powell said, but I think, look, there was a time and place where what Powell said matters. I used to listen to him all the time for the last 2-3 years, but this time I didn't listen to any bit of what he says. He is irrelevant in the scheme of things now.
Right, Anurag. So from your vantage point, of course, you're looking at it that way. But Mayuresh, I want to come back to do evaluations continue to be a worry for foreign investors?
To a certain extent, yes, because they had been chasing Indian markets where earnings were growing in higher double digits. And I think they grew in higher double digits for the better part of COVID and a year after that as well. But I think with the higher base that has got created and with consumption clearly slowing down over the last few quarters, it was very, very evident that the earnings growth had come off quite a bit. And therefore, I think the premium that Indian equity markets probably got because of superior earnings growth. As earnings deaccelerated, I think the foreign investors probably did not see any sense in terms of the valuations which then traded at a premium. Because when you were trading at a premium valuation, your earnings were growing at a stupendous pace. And therefore, I think the entire question that the market now has is with GST rationalization, does the earnings scenario come back as we start the second half of this fiscal and continues post that? And therefore, I think the moves that the central government has probably done in the right direction to boost consumption the income tax cuts or rationalization that has probably happened with the new income tax code, with incomes up to 12 lakhs exempted, will also give a boost to urban and semi-urban consumption. And therefore, I think one of the legs in terms of GDP growth, which is consumption-led, should start coming back very strongly, supporting earnings. The other element in terms of investments, and specifically in terms of government capex, might continue, might come off a tad bit in terms of balancing the fiscal deficit that the government needs to maintain with the loss that they, or the compensation that they need to do in terms of the GST rationalization and the cuts thereof. But private capex is showing signs of coming back and revival, and therefore the green shoots there is also a very positive sign, which might also aid the GDP growth going forward. So in my opinion, I think the hope is the second half will bring about earnings growth. And if that starts coming through substantially as we head into Q4, I think foreign investors will probably start coming back because India will be one of the few economies in the world where earnings, fiscal consolidation, and inflation, the trinity might probably still remain in favor compared to a lot of economies in the world.
Right. In fact, Mayuresh, that was going to be my next question on FIIs, given the fact that we've seen a selling spree in the FII segment as well. There was some buying by DIIs as well, but FII selling, that seems to be the key theme that we've noticed over these past couple of months. Why are investors cautious, even as the government has introduced the massive GST rate change exercise that's expected to boost domestic consumption? The government is doing a lot as far as, an infra push is concerned. On the exports front, why do you think investors are cautious, Anurag, at this point in time, and is this FII selling shaping up to be a longer term trend?
Yeah, so the FII selling is a long-term trend. I think introduction of capital gains where FIIs don't face capital gains tax in most of the countries where they invest, which is most of the countries which are relevant. But India introduced those your capital gains tax. So today, if I invest in India ETF or any such version or FIs who are there, they get their capital net of taxes, which is very unique to India. So that itself kind of dents the return. So if I get 10%, I might get about, close to 8%. That saddled with the fact that RBI was trying to peg the currency in a range for like last 2-3 years. So it stayed between 82 to 84 for quite a long time, I think more than a couple of years.
Yeah, don't carry this
So
tomorrow.
So I think then we are seeing that currency depreciation now beginning to reflect in the INR dollar conversion. So I think if you add the two and together with the valuation of the Indian markets, then I think effectively you need to really be making good 15-20% returns before you can effectively end up making 12-13% returns. That equation is not very good for the time being. Eventually also, if you see, I think there might be a trend to it, but India is promoting domestic champions more than the multinational companies. And I think that seems to be a designed, well thought out plan. And that also is reflecting in the trade policy. So all of this kind of indicates that foreign capital will try and find places which are more amenable. Valuation is a key. Look, FI is not a FDI money. They don't have to put plants and machinery and deal with the labor regulations. It's a short-term money. If I see the market's correct, we will jump in. Everybody will jump in, right? But these prices are pretty overheated, right? There is a contraindicator. I must leave the investors with this thought. When the retail jumps into the fray, all guns blazing, that's the time to sell. But when the retail is scared, that's when you get good prices. That's when the institutions buy. The equation has always stayed like this for, in almost every market, and Indian market is no different, right? So right now, retail is all gung-ho. I think it is the time to be cautious, right? Because they don't get it, right? But investors do, institutional investors do, right? So it's just a simple math as well, to some point.
Right, Anurag. Fair points that you make there. But Mayuresh, I'll come back to you, given what Anurag, of course, did put into perspective and also in tandem with what you were also saying about FIIs going ahead and how that's going to look like. But are there bottlenecks or challenges on that front?
No, absolutely. I think certain pockets have become very, very expensive. And therefore, I think if one probably tries to justify the price action in terms of the premium tag that India might get in terms of an earnings revival happening in the second half and the quarters down the line, I think it's a little bit of a premature thinking. Obviously, I think certain pockets from a macro strategic top-down perspective look very, very attractive. For example, I think the financial services space, very, very selectively, I think NBFCs as a space might actually continue doing well because with the interest cut cycle that you've probably seen, their cost of borrowing actually goes down significantly. And again, I think the expectations in terms of a consumption boom coming through, both on the urban and the rural side, I think that does give impetus in terms of strong balance sheet growth. So better rated leadership NBFCs where capital adequacy, credit rating is top notch, might actually deliver a very, very strong earnings growth going forward. A few of the domestic oriented sectors, which are again consumption led to a large extent, selective FMCG, hotels as a stock, hotels as a pocket as an example, within capital goods or capex as a theme, I think energy as a space selectively, cement as a space selectively, I think might continue doing well because I think the government focus, as I said, in terms of capex, private capex coming back and consumption actually picking up. Might make these pockets selectively attractive. And therefore, I think you need to have a sector and a stock specific approach in the current juncture and where valuations and the
Okay.
market is to be formulated.
Okay, Anurag, I'll come to you on that point. Which sectors are seeming attractive to you at the moment? We've seen the kind of GST push the government has given. So definitely consumption is going to be on investors' radar. Defense is also getting some sort of opportunities, some visibility. And then power is also one interesting sector. Which sectors are you bullish on? And secondly, second part to this question is the fact that how much of a game changer is the India-US deal going to be for the Indian markets?
So let's address the last one first, okay? India-US deal is pretty much done. I think that's where it's going to stay for now, okay? And I've been very categorical about it. Look, I think Indian government has made up its mind that it's not going to open the markets within India to US products or services, right? And and I think US likewise has made its mind that, okay, then let's avoid the discretionary. Let's only import the the cell phones. So Apple is exempted, pharma is exempted. So this gives you about 30-40 billion, and rest of it is kind of tariffed, right? So India is taking what India needs from US without tariff. US is doing the same. Everything else is tariffed, right? And that's pretty much the equilibrium we are going to stay at, right? And that's the cost of keeping the market closed. That's fine. It's a decisive judgment by Indian government, and that's how I read into it. So I think we should move on from there because Indian market doesn't depend so much on the exports element of it, right? It's just a small point. By the way, because H1B is just flashing on the screen, H1B issue by the Trump is not a retaliation of tariffs and other things, right? It is a very parallel track. It was an issue which was a pre-election promise. So don't try and link H1B issue with the tariff situation. Finally, Sumita, in terms of, I think I totally concur, I mean, totally as in partially concur with Mayuresh when he says, the pockets to invest, but let's understand my perspective to invest in India is more of diversification and capital protection from US markets in case things go wrong. I use Indian markets as a hedge and not as a way to gain capital appreciation, right? So my hedge of 5-10% of allocation to emerging markets is usually to safer pockets of banking and healthcare and not into the aggressive capital intensive small caps or some of those sectors, right? So the
Anurag, I'll
perspectives
have to
might be
interject
different.
you
Yeah.
there, but fair enough, given I think how Sumita also asked that question where there's so much to be really decoding as far as the trade talk is also concerned. But for the moment, I'm afraid I'd have to interject you because we're running short of time. But thank you as well as Mayuresh for taking the time out and joining us here this evening on India Tonight. For the moment,